Today we'll be discussing multiplier models. So there are four multiplier models or four ratios that we have to discuss. The first is the PE ratio, second price to book value ratio, the third is price to sales ratio, fourth price to cash flow, and the fifth is EV EBITDA. The most important out of the lot is the PE ratio. So we'll start our discussion with what PE ratio is. Now PE ratio. Now this is one of the most widely used valuation multiple used by investors across the globe. And how do you calculate the P ratio? P ratio is calculated by dividing price by
Share price.
EPS, right? You calculate the P ratio by dividing the price of the stock with its EPS. Okay. Now say if the price of the stock is 100 and price of the stock is 100 and EPS is 5. Just a second. Price of the stock is 100, EPS of the stock is 5. How do you calculate EPS? Any idea, guys? How do we calculate EPS?
Net income by outstanding shares.
Yes, EPS equals net income divided by number of outstanding common equity shares. So, if the price of the stock is $100, EPS is $5, what is the P ratio? 100 by 5, which is 20. Now, what does this number signify? What does the P ratio signify? So now there are two interpretations of P ratio. The first interpretation is that if the P ratio of a stock is 20, that basically means that if the P ratio of the stock is 20, that basically means that the stock is trading at 20 times its earnings. The stock is trading at 20 times its earnings. What could be the second interpretation of P ratio? Guys, please tell me what could be the alternative interpretation of the P ratio? So the alternative interpretation of P ratio is that P ratio tells us the amount of money, tells us the amount of money investors are willing to pay for each dollar of company's earnings. So if the P ratio of this stock is 20, that basically means that an investor is willing to pay $20 to receive $1 of company earnings. Right? Guys, are we good? Have we understood this? Guys, are we good here? Any doubts with the interpretations? Because the interpretation is very important. Any doubts here, please, guys?
सर एक बार सेकंड वाला रिपीट कर दो.
So basically, if the P ratio of the stock is 20, that basically means that investors are willing to pay $20 to receive $1 of company's earnings, right? So the second interpretation is that the P ratio tells us the amount of money investors are willing to pay for each dollar of company's earnings. ठीक है संकुश? Right?
Yes sir. Yes sir.
So what does a higher P ratio indicate? Now we'll follow the second interpretation. What does a high P ratio indicate? What does a high P ratio indicate? Can I say that a high P ratio indicates that investors are willing to pay more? Yes, can I say
Yes,
that?
sir.
Yes.
So a higher P ratio basically means that investors are willing to pay more for each dollar of company's earnings. And naturally, guys, investors would be willing to pay more if they are optimistic about the company's future earnings, right? They would be willing to pay more only when they are very optimistic about the company's future earnings, right? They would be uh, expecting rapid growth in the earnings of the company. That is when they would be willing to pay more. And what does a low P ratio indicate? That basically means that investors are willing to pay less. And why will investors pay less? Can someone tell me? Why will investors pay less?
When they are not optimistic about
When yes,
the
when they are
growth of
pessimistic about company's future earning growth. When they are pessimistic about it, they would be willing to pay less, right? So see, with this discussion, we can basically conclude that P ratio is a function of earning growth. P ratio is a function of earning growth, right? So if earning growth is expected to be higher, if the market is very optimistic about the company's future earning growth, then P ratio would be high. And if the market expects sluggish growth, if the market is pessimistic about future growth of the company, then they would be willing to pay less for that company and the P ratio would be low, right? So P ratio is a function of earning growth. Guys, are we good here? So please write down high PE stocks are usually stocks where market is optimistic, right? Optimistic about future earning growth. And low PE basically means market is pessimistic about future earning growth, right? Now we can also use the P ratio, as we can also use the P ratio to identify whether the stock is undervalued or overvalued. You can also use the P ratio to find stocks that are undervalued or overvalued. Now how? Now guys, you compare stocks within the same industry. You compare stocks within the same industry and with the same growth rate. The stock which trades at a lower PE is undervalued and the stock that trades at a higher PE is overvalued, right? So let's say there are two stocks in an industry, right? And say this is FMCG industry. In the FMCG industry, there are two stocks, A and B, right? Earning growth for both these stocks are 20%. Earning growth for both stocks are 20% each. And P ratio of stock A is 10, P ratio of stock B is 20, right? Let's add another stock, stock C. Stock C also has a earning growth of 20% and its P ratio is 15. Now, guys, please understand, when we buy stock A, we are paying $10 to buy 20% growth. When we buy stock A, we are paying $10 to buy 20% growth, right? And when we buy stock B, we are paying $20 to buy the same growth rate. So we are paying less when we buy stock A. Guys, can we understand this? We are paying less to buy stock A. Can I say this, guys?
Yes.
Yes, sir.
So we are paying, when we buy stock A, we are paying um, less to buy the same earning growth. We are paying less to buy the same earning growth when we buy stock A. So we can say that the price of stock A is cheap, right? We can consider the consider the price of stock A to be cheap, or we could come to a conclusion that stock A is overvalued, right? So we can also come to this conclusion: stock A is offering same growth at a lower price than B and C, then stock B and C, right? So if we compare it, companies within the same industry and with the same earning growth, the stock that trades at a lower P is undervalued, the stock that trades at a higher P is overvalued, right? Here stock A is offering the same growth at a lower price than stock B and stock C. We are paying only $10 to buy 20% growth when we buy stock A, but we have to pay more. We have to pay $20 to buy the same growth when we buy stock B, right? So stock A is offering more growth at a lower price. So we'll say stock A is undervalued, stock A is cheaper, stock A is relatively inexpensive, right? So this is how P ratio can be used to identify which stocks are undervalued, which stocks are overvalued. Now I'll give you a more broader perspective, right, guys? We can calculate the P ratio of a index, right? We can calculate the PE ratio of an index. Though this is not a part of your syllabus, but this will help you a lot in your overall study of the market, right? We can calculate the P ratio of Nifty 50. How can we calculate the P ratio of Nifty 50? Okay, so how do we do this? Basically, we sum the market cap of all the stocks of all the 50 stocks in Nifty and divide it by the sum of PAT, sum of profit after tax of all stocks in Nifty 50. And once we do this, we'll get the P ratio of Nifty, right? We'll get the P ratio of Nifty. Now, P ratio of Nifty has been in the range of 10 to 30 since the last 20 years. It has been in the range of it has been in the range of 10 to 30 since the last 20 years, right? And guys, every time the P ratio of Nifty is 14 or less than that, right? If P ratio of Nifty is less than or equal to 14, then Nifty is undervalued, right? And Nifty is expected to increase after this, right? When P ratio of Nifty falls down to 14 or less, right? You can expect a bounce back in the market, right? So see, in December 2008 and Jan 2009, Nifty P was around 13, right? P ratio of Nifty was around 13 in this period. And guys, you will, I can show this to you that Nifty gave a return, an annualized return of almost 70% in the year 2009. It gave an annualized return of around 70% in 2009 because its P ratio was very, very low. Nifty was undervalued. We'll just check this out as well. Guys, in December 2002, Nifty P ratio was around, in December 2002, Nifty's P ratio was around 15. And we saw around a 70% return in December 2003 as well. We saw 70% return in the year 2003 as well, right? In the calendar year 2003. So if Nifty's P is less than 14, it's considered overvalued, and when its P is greater than 22, When its P is greater than 22, we can say that Nifty is overvalued. And guys, the periods that follow such a high P, we usually see negative returns. We usually see negative returns. So this is for your fundamental. This is for your, this is for your practical knowledge, right? So here what we are doing, we are comparing the P ratio to the historical P ratio, right? We are comparing the P ratio of Nifty to its historical P ratio to find whether Nifty is undervalued or overvalued. But guys, a very important point here, P ratio should not be used in isolation and should be considered with other financial metrics of the firm, with the other fundamentals of the company. Right? I'll give you an example here, guys. Now we'll see the P ratio of Nikon over the period of 2012 to 2016. Right? We'll see the P ratio of Nikon. What did Nikon manufacture, guys? Do we know? What does Nikon
Camera. Camera.
P ratio of Nikon from 2012 to 2016? Now, in 2012, P ratio, just a second, guys. In 2012, P ratio of Nikon was 10.25. In 2013, it was around 20.56. 2014, it was around 20, it was around 30. 2015, it was around 12. And in 2016, it was 10. Right? So looking at these P ratios, if we are, if in 2016, if we looked at the P ratios from 2012 to 2015, we will basically say that, Nikon is, the P ratio of Nikon is at its historical low in 2016. Right, guys? Can we say this? P ratio of Nikon is at its
Yes.
historical
Yes.
low
Yes.
in the year 2016. So you might feel that the stock is, you might feel the stock is undervalued or overvalued.
Undervalued.
Yes, you might feel that the stock is undervalued, but it's actually not. It's actually not. P ratio is low because of slowing revenue of Nikon due to growing popularity of alternative cameras and smartphones, which severely affected Nikon's business. Right? So So a low P ratio does not necessarily mean that the stock is undervalued, and a high P ratio does not necessarily mean that the stock is overvalued. Right? It is not necessary. We have to compare the P ratio of the company with its financial performance, with the industry trends, and the future growth prospects. Now, due to the advent of new technology, people, due to the advent of smartphones, people stopped buying cameras. It was only professional photographers that used to buy cameras, but normal people used to use their, they started using their phones rather than buying cameras. Right? No one buys digital cameras, and we don't usually buy digital cameras. Its sales have reduced drastically, and that is why, you know even though Nikon's PV ratio is so low, it's not undervalued. It's not undervalued, right? P ratio was low because of slowing revenue of Nikon and growing popularity of alternative cameras and smartphones. So, guys, the very important point that you should write here is that two important points that we have to write here. Please note this down. The first point that we should note down here is that low P does not mean that stock is undervalued, and high P does not mean that the stock is overvalued. Low P does not mean that the stock is undervalued, and high P does not mean that the stock is overvalued. We have to compare the P of a stock with its financial performance, industry trends, and future growth prospects. Please note down this point. Second point, please note that there is no single good PE ratio. Please note this down. This is a 5-star point. There is no single good PE ratio. There is no single good PE ratio for a stock or an industry. There is no single good P ratio for a stock or an industry because P ratio is a comparison tool and not a benchmark figure. Because P ratio is a comparison tool and not a benchmark figure. Guys, are we good here? Any doubts up till now?
Sir, yes, sir, because P ratio is
Because P ratio is a comparison tool. It's used for
okay.
comparing, right? So you can compare the P ratio of a stock um, with the average P ratio of the industry, right? With the average P of the industry, you can compare the P ratio of a stock with its industry peers, right? Or you can compare the P ratio of a stock with the historical P. That's what we just did when we discussed the example of Nikon, right? Guys, are we good? Any doubts? Yes or no? Please tell. Is anyone having any kinds of doubts, please? All good? Should I proceed?
Yes, sir.
Okay, so now please make this chart. See, a low PE, a low PE can mean that the stock is undervalued, or it could mean that investors are pessimistic about the company's future earnings. So it could mean either of the two things. How will we identify whether the stock is undervalued? We'll compare stocks in the same industry with similar growth, right? We'll compare the P ratio of a stock with stocks, with similar stocks in the industry which have similar growth, right? And the stock which has a lower P would be undervalued, right? This example that we just did, this example here, right? This example can help us identify a undervalued stock, right? And a low P because investors are pessimistic about the company's future earnings, and that is why they are not willing, uh, that is why they are willing to pay less per dollar of company's earnings. That is why they are willing to pay less. Okay, the example that we just did is Nikon. Now please note what are the interpretations of a high P ratio. Guys, can you tell me interpretation of a high P?
Stock is overvalued
First is stock is overvalued.
or investors are optimistic about future earnings.
Investors are optimistic about future earnings, and that is why they are willing to pay more. Okay, guys, do we know what was Adani Enterprises P ratio before the Hindenburg report came out? Any idea, guys? Guys, any idea what was the EPS of Adani? You would have seen that the stock fell around 26% today. So just search EPS of Adani. What is the EPS, guys? Please note the EPS. How much is it?
10.7.
10.73.
3. Before the Hindenburg report, um, the price of Adani was around 3,800.
Yes, sir.
Let us see. 1 month. As you can see that the price was around 3,841. Now calculate the PE ratio of Adani. 3,841 divided by 10.73. How much is it? 3,841 divided by 10.73. 3,841 divided by 10.73. How much is it?
35.5.
No, 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 no. Must be very, very greater than that.
357.
37.9.
350.
350.
Yes. So the P ratio of Adani was 350. And why were people paying 350 rupees for every rupee of the company's earnings? Because they were very optimistic about Adani. People thought that Adani is close to the government. Adani is going to grow at a very fast rate. That is why they were paying so much. And one report against it, right? One report against the fundamentals of the Adani enterprise. And what's the P now, guys? 200, right? What's the P now? 200. So, guys, you know, there can be a massive re-rating of a stock which trades at a very high P, right? So, a growth stock can become an overvalued stock very, very fast. Please keep this in mind, right? That is why people, it has been seen historically that stocks that trade at a lower P are, they tend to do better than stocks that trade at a higher P. So, Nana, the calculation is that the price of the stock 1 month before was 3,841. EPS of the company was 10.73. So, the P ratio of the stock is price by EPS, which is 3,841 by 10.73, which is around 350. So, guys, see, this was the level of optimism in the investor's mind for Adani that they were willing to pay 350 rupees per rupee of earnings. And one bad report, and there is a massive re-rating. There is a massive P re-rating, right? The P has been reduced from 350 to 200. Although there has been no change in the EPS of the company, the EPS of the company is still the same.
Yes, sir.
Yes,
Yeah, reports.
it's just because Hindenburg came out with a very solid report against Adani Enterprises. The stock has fallen, right? So we need to be very cautious about stock, growth stocks. What are growth stocks? Growth stocks are basically stocks which investors believe would grow at a very rapid rate in the future, right? Stocks whose earnings would grow at a very rapid rate in the future are basically your growth stocks, right? Now, guys, we can use the P ratio to uh, see. So Adani Enterprise was primarily was basically a growth stock before this Hindenburg report, but after the Hindenburg report, it became overvalued. Right after the report, it became overvalued, and its P is still very high. 200 P is not. It's not cheap. It's very, it's still very high. It's not low. You know. So, uh, that's how you can look at things, right? And you can also use P ratio to find undervalued stocks, right? You can use P ratio to find undervalued stocks, but naturally you'll have to see other things as well. You can't use P ratio alone to find undervalued stocks. You have to use it with in conjunction with the company's fundamentals, like its earning growth, like its debt equity, like its you have to look at the dividend yield of the company. So one such undervalued stock that I feel is undervalued right now is Coal India. Now, guys, Coal India. Uh, what does Coal India do, guys? Any idea? What does Coal India do?
Mining.
Yes, it's into coal mining. And guys, you would be surprised to know that it's the largest coal producing company in the world. Coal India is the largest producing company in the world, and it's producing 82% of India's total coal. So it's basically, it has a monopoly in the coal mining market in India. It has a monopoly. Now, guys, it's trading at a P ratio of
4.7.
4.7. 4.7.
4.7. Yes. So the P ratio is really, really low. Right? P ratio is low. It has almost no debt. It has a it has a debt equity of zero. It has no debt in its books. Look in Google, find what is its return on equity. As far as I remember, its return on equity was 43%. Right? Its return on equity was very, very high. What does a return on
43.
equity of 43% tell you? We had discussed ROE in the last class when we were discussing SGR, sustainable growth rate. What was ROE?
43 cents for every dollar.
Yes, for every dollar of equity financing, the company is generating 43 cents in earnings, right? For every dollar of common equity financing, Coal India is generating 43 cents or 43 pesos, right? So it's generating 43 uh, cents in earnings, right? And guys, it has a dividend yield of, what is its dividend yield, guys? Just look into Google. What is the dividend yield?
7.7.
7.7. How do you calculate dividend yield? Dividend yield is calculated by, you divide the annual dividend by the price of the stock. Divide the annual dividend by the price of the stock, right? So annual dividend of Coal India is 7.7, and dividend yield basically tells you the dividend that an investor receives for every dollar that he has invested in the company. So for every rupee um, that you invest in Coal India, you get approximately 8 paisa of dividend. For every rupee that you invest, you get 8 paisa in dividend. That is, for every dollar you invest in this company, you get 8 cents in dividend. So, guys, uh, yesterday, Coal India's quarterly results came out. And in the quarterly results, guys, it showed 70% growth in net profit. 70% growth in net profit uh, in quarter ended December 2022, right? So with the overall perspective, seeing at the overall perspective, with Coal India being a monopoly, with no debt in its books, with such a high growth in earnings, and such a high dividend yield, such a high return on equity, now if you look at this P, you can safely say that this company is undervalued and is expected to do well in the future. Guys, this is how you can use the P ratio. If the P ratio were to be 40 or 50, then naturally we would not have invested in this particular stock. We would have thought that, okay, um, these fundamentals are already priced in the stock. That is why the P ratio is high, right? So we would not have invested in this stock if the P ratio would have been higher. But it's because the P ratio is low, we are getting very high growth at a low price. We are getting high ROE at a low price. We are getting high, a lot of dividends at a lower price, right? And the company has no leverage, no debt in its books, so we can safely assume that it's a undervalued stock, and we should see that in the recent future the stock should do well. Though because of the Adani crisis in India, I don't see that the markets would do well in the recent future. There will be a lot of volatility, but over a 6 month, 1 year horizon, I seriously feel that Coal India should do well. Right, guys, are we good? Have we understood? So, if the P ratio would have been higher here, we would not have been so confident in investing in the stock. Then this stock would not have been such a safe investment, right? Because if the P ratio would have been higher, we would be paying a higher price. But now the P ratio is lower, we're paying a lower price, right? Guys, are we good? Any doubts, please? Is anybody having any doubts? Please let me know, yes or no. Should I move forward?
Yes, sir.
So don't buy Coal India tomorrow just because I said, right? Okay. Okay, guys. Now there are two kinds of P ratios that we can discuss. That that we can calculate. One is your trailing PE, and the other is your forward PE. How do you calculate trailing PE? Guys, trailing PE is basically your current price of the stock divided by the actual EPS in the last 12 months. And forward P is calculated by dividing current market price by estimated EPS over the next 12 months. Now, trailing PE, since it uses the actual PPS in the last 12 months, since it's using the historical EPS, right? It is backward looking in nature because it's using the EPS of the period that has gone by, right? So it is historical in nature. It is backward looking in nature. Sorry, it is backward looking in nature. It is backward looking in nature, and naturally forward PE, because it's using estimated EPS, it's forward looking in nature, right? It's forward looking in nature, right? So guys, although forward EPS, forward P ratio, since it's accounting for the expected EPS, since it's using the forecasted EPS, it may be forward looking in nature. It may be a better indicator of the company's future earning potential. It has some problems. This forward PE, though is forward looking in nature, it's a better indicator of the company's future earning prospects. It has some problems. Guys, if the estimated EPS and the actual EPS, right, turn out to be different, if the estimated and the actual EPS turn out to be different, then the forward PE would be, forward PE would give us biased results. If actual PE and estimated PE are turn out to be different. Please note this down. Forward PE gives us biased results if actual and estimated PE are different. That is why in the market, guys, we commonly use the trailing PE ratio. We commonly use the trailing PE ratio because it measures actual earnings over the estimated earnings, right? That's why we use the trailing PE ratio because it uses actual over estimated. Guys, are we good? Have we got this idea? Any doubts here, please? Is anyone having any doubt? कोई doubt नहीं है.
Good, sir.
All good.
I'm not clear. I'm not
Huh?
clear. The actual EPS and estimated EPS, like the current.
Okay. So understand this, Victor. Say the current market price of the stock is $50, and the last 12-month EPS is last 12-month EPS is $5, and the market is expecting a 10% growth in EPS, right? So the estimated EPS in 1 year is 5 into 1.1, that is 5.5. Market is expecting EPS to increase by 10%. So estimated EPS is 5.5, right? So trailing PE would be, Victor, trailing PE would be how much? Current
Around
market price by
10,
last 12-month EPS, right?
10.
That
Yeah,
is how much? 50 by 5. That is 10. And forward PE would be how much? Current market price by expected EPS, which is how much? 50 by 5.5. That is how much? 50 by 5.5 is how much? Please tell me.
9.09.
9.9.
9.09.
So guys, the thing that I'm trying to tell you, if the estimated growth in EPS, we had estimated the growth in EPS to be 10%. But if it turns out to be less than 10%, then our forward PE would be incorrect. It would be biased. Right, guys? Victor, if our estimated growth in, we had estimated that EPS would grow by 10%, but in reality, or the actual growth is say less than 10%, right? Say it's 5%, then our, then our forward PE would be incorrect, right? Because we calculated the forward PE using an EPS growth of 10%, but the uh, actual EPS growth turns out to be less than 10%. So the my forward PE would be biased. Right, Victor? Have you understood this or not?
I'm good, sir.
Okay, guys, any doubts up till now? I'm moving to the most important part now, which is your justified forward PE ratio. Now, what is the justified forward PE ratio? It is the P ratio. Please write this down. It is the P ratio at which the stock should ideally trade. It is the P ratio at which the stock should ideally trade given its fundamentals. It is the P ratio at which the stock should ideally trade given its fundamentals. That is why we use the term justified. Or you can say that this is the intrinsic P ratio. This should be the real P ratio of a particular stock. Right. Okay, guys, when we discuss the Gordon growth model, the intrinsic value of a stock, how did we calculate the intrinsic value of a stock? Guys, when we use the Gordon growth model, how did we calculate the intrinsic value of the stock?
Last year, dividend D0 into 1 plus growth rate.
Yes, so we said that the intrinsic value of the stock P0 is equal to D0 into 1 plus growth rate divided by
RE,
RE
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 minus
minus G.
G, right? Or this equation can be rewritten as intrinsic value of the stock P0 is equal to D1 by RE minus G, because D0 into 1 plus G to the power 1 is nothing but D1. right? So this equation can be rewritten like this. Now, guys, we are trying to, please understand, we are trying to calculate, or we are trying to arrive at the formula which shall give us the intrinsic or the justified forward P ratio, right? We are trying to arrive at the formula which shall give us the intrinsic or the justified forward P. Now, guys, we divide both sides of the equation by estimated earnings or expected earnings or forecasted earnings, right? And we shall denote forecasted earnings by E1. Okay. Guys, what is P0 by E1? Can I say P0 by E1 is my forward P ratio? Guys, can I write this? Price of the stock by
Future.
estimated earnings or future earnings. This is your forward P ratio. And D1 by E1, can I write this is my dividend payout ratio in 1 year? Guys, do you remember what dividend payout ratio was? DPR was dividend by
DPS.
dividend per share by
By earning per share.
divided by EPS. And what did DPR signify? The amount of profits or the percentage of profits that we are paying out as dividends.
Dividend.
Yes, it's the percentage of profits that we pay out as dividends. Right. So P0 by E1 is my forward P, and D1 by E1 is my dividend payout ratio divided by required return by equity investors minus growth rate. So this is the formula of my justified P ratio. This is the P ratio at which the stock should ideally trade. This is the forward P ratio at which the stock should ideally trade. Right? Guys, have we understood the how we came out to this particular deduction? How I arrived at this particular formula is the mathematics. Okay, guys? Guys, have we understood the mathematics? Yes or no?
Yes, sir.
Just a second. Yeah. So let me highlight this.
सर वन थिंग लाइक प्रीवियसली जब हम कैलकुलेट कर रहे थे डिविडेंड पे आउट रेशियो सो वी अज्यूम दैट इट्स जस्ट एन अर्निंग पर शेयर नॉट एज अ फ्यूचर अर्निंग पर शेयर
Hmm.
जब सर पहले हम लोग डिविडेंड पे आउट रेशियो डिस्कस कर रहे थे
Hmm.
तो वहाँ पे हमने सर जो फॉर्मूला यूज किया था तो हमने डीपीएस बाई मतलब डिविडेंड पर शेयर डिवाइडेड बाई अर्निंग पर शेयर हमने फॉर्मूला यूज किया था
Hmm.
but currently we are using in when we're justifying using it so we are using the for मतलब forward earning मतलब future earning per
हाँ, तो
share.
आपने ऊपर में भी तो D1 ही यूज कर रहे हैं ना, सो वी दिस इज योर एक्सपेक्टेड डिविडेंड पे आउट रेशियो. This is your
Okay.
expected dividend payout ratio. You are dividing the dividends that you will pay in 1 year by the uh, estimated earnings in 1 year. ठीक है ना? It's the
Okay. Okay.
so it's we are not doing D0 by E1, right? We are not doing this. D0 by E1 नहीं है ये सुप्रतीक, right? So we are not
Okay.
dividing current dividends by estimated earnings. We are dividing future dividends by estimated earnings. ठीक है ना? So this D1 and this E1 are from the same period, right? We are not dividing current dividends by estimated earnings. ठीक है? Clear है?
Yes sir.
Okay. Now guys, this ratio can be used to make a number of inferences. Please note down, this is very important from the examinations perspective. बहुत ज़्यादा important है from the examinations perspective. एकदम ध्यान से लिखो. पहले please write down justified forward P ratio is the ideal P ratio, ideal forward P ratio that a stock should trade at given its fundamentals. It's the ideal forward P ratio that a stock should trade at given its fundamentals.
So please repeat.
It's the ideal forward P ratio that the stock should trade at given its fundamentals. अब heading लिखो बड़ा बड़ा. Please write the heading. We can use this equation, this particular equation, to make a number of inferences. We can use this equation to make a number of inferences. पहला लिखो. Give heading growth rate. Growth rate. Right, growth rate is directly related to justified P ratio. Growth rate is directly related to justified P ratio. Justified forward P ratio. Growth rate is directly related to justified forward P ratio. Now please understand, if growth rate is high, then the denominator of this ratio would be low or high?
Low.
Low. If denominator is low, then justified P ratio would be high or low?
High. High.
So guys, if the growth rate of a stock is high, its justified forward P ratio would be high. And this is what we just, in the starting of the class, we had discussed this only, that P ratio is a function of growth. Higher the growth, higher the P ratio, lower the expected growth, lower the P ratio. Higher the expected growth, more the investors are willing to pay to buy the stock, and lower the expected growth, uh, the lesser the investors are willing to pay to buy a particular stock. So if growth is high, denominator of this ratio would be low, and justified P ratio, justified forward P ratio would be high. So please write down justified P ratio or justified forward P ratio is a function of growth. Higher the growth rate, higher the justified P ratio, and vice versa. And this is what we exactly discussed at the starting of the class. Okay, now please write RE, required return by equity investors. Okay, guys, higher the RE, lower the denominator or higher the denominator? Higher the
Higher the
required,
denominator.
higher the denominator.
Lower denominator. Lower numerator.
Lower the ratio, lower the justified forward P ratio. Right? So, if investors require a lot of return from a particular stock, then its justified P ratio would be lower, right? And guys, please understand the conditions in which required return would be high. Now, the first is, how do we calculate required return by equity investors, guys? We use the CAPM formula, RF plus RM minus RF into what, guys? Into
Theta.
beta. So guys, if the
Beta.
beta of the stock is high, then required return by equity investors would be high, right? If beta is high, required return by equity investors would be high, and justified P ratio would be low. If beta is high, required return from equity investors would be high, and justified forward P ratio would be low. Justified forward P ratio would be low. Beta is high for what kind of stocks? Guys,
Volatile.
Growth stock.
volatile. Yes, which sectors?
EV.
Hmm?
EV.
Real estate.
Real estate.
Yes, real
Capital
estate,
intensive.
capital intensive. No, cannot exactly capital intensive. See, non-cyclical stocks usually your cyclical stocks have high beta. Your cyclical stocks have high beta. Please note down, cyclical stocks have high beta. What are cyclical stocks, guys?
Seasonal stocks, which is
Whose earnings are tied to the business cycle, whose EPS are tied to the business cycle. Cyclical stocks do well when the economy is doing good, and they do poorly when the economy is in a recession, right? They do good, they do really good when the economy is doing well, and they do poorly when the economy is in a recession. So can you name a particular stock which is cyclical in nature?
Tata Steel.
See guys,
Automobile.
automobile, right? People will buy more automobiles when the economy is doing good, when the economy is booming, right? Then all companies who produce luxury goods, right? All luxury good manufacturers would be would be their stocks would be cyclical in nature, right? Then guys, uh, all metal stocks are cyclical. Why? Guys, all metal stocks do well when the economy is booming, and they do poorly when the economy is in a recession. Why? Because if the economy is booming, industrial activity would be high, and if industrial activity would be high, then obviously to build industries, to build factories, you require metals, you require iron, you require steel, you require copper, and all of that stuff, right? So such sectors, your automobile sectors, your luxury goods sector, your primarily your steel sector, right? This steel sector is cyclical in nature. So guys, go find the P ratio of Tata Steel, go find the P ratio of SAIL. You will see that P ratio of Tata Steel and SAIL is very low.
very less.
How
Very
much is
less,
it? Please
yes.
tell me.
So five something.
Yes, so P ratio of Tata Steel is very low. Why is it low? Because it is cyclical, right? So don't think that Tata Steel P ratio is low, so it is undervalued. It is not like that. It is P ratio of Tata Steel is low because it's a cyclical stock, right? It's a cyclical stock. Its ideal P ratio should be low only, given because its earning is tied to the business cycle, right? So don't think that okay, Tata Steel's P ratio is very low, so it's undervalued, we should buy it. No, its ideal P ratio should be low, right? Because it's a cyclical stock. It does well when the economy is doing good. It does poorly when the economy is in a recession, right? So cyclical stocks have high betas, and since they have high betas, um, required return by equity investors is high. Their forward P ratios are justified. Forward P ratios should be low. Guys, is this point crystal clear? Any doubts, please?
No, sir.
Okay. Now, guys, your required return by equity investors could be high because there is a lot of debt in your capital structure. If there's a lot of debt in the capital structure now, then then required return by equity shareholders increase. Can you think why? If there's a lot of debt, How does the required return by equity shareholders increase?
So more risk because like because the debt holders can sue the company if they are not paid back.
So see, if there's a lot of debt in the
The
capital
beta will
structure,
increase.
see if there's a lot of debt in the capital structure and the company goes into liquidation, the debt holders would be repaid before equity shareholders. And if the level of debt is high, then there are high chances that the equity shareholders would not be repaid, right? So there are high chances that if there is a lot of debt, equity shareholders won't be repaid, right? Because debt holders would be repaid before equity shareholders. So it might be the case that the all the cash of the company gets exhausted after repaying the debt holders. There is no cash left to repay the equity shareholders. So if there's a lot of debt, risk to equity shareholders increase, and since the risk to equity shareholders increase, the return that they require to invest in that particular stock increases. So please note this down. If the required return, if there's a lot of debt in the capital structure, required return by equity investors increase. Or rather, write it in this fashion. If there is a lot of debt in the capital structure, risk to equity shareholders increase and they require more return to invest in the company's equity. So required return increases. Guys, are we good with this point? Are we good? Any doubts here? Anyone having any doubt? This is very important, guys. All this is very important. Chalo bolo.
Good,
Koi
sir.
doubt? Anyone?
No, sir.
Supratik, Anmol, Ayush, Umang, Sankosh, Ananya, Sayyed, Victor. Is anyone having any doubt? No.
No,
So
sir.
if the debt structure increases, the justified P ratio will reduce, right?
Right? Because RE increases, so justified PE would decrease. Right? RE increases, justified PE decrease. Okay, last is dividend. Now, please note down the effect of dividend on PE ratio is ambiguous. The effect of dividend payout on PE ratio is ambiguous. Okay. Now, see, if we look at this equation of justified forward PE ratio, it looks something like this. Dividend payout ratio by RE minus G. So you might think that dividend payout ratio, you might think that dividend payout ratio is positively related to justified P, right? Because dividend payout ratio is in the numerator, so higher the numerator, higher the ratio. So you might think that dividend payout is positively related. It may seem or it may appear to be positive related to justified forward P, but it's actually not. It's actually not. It seems like because DPR is in the numerator, so you might think higher the numerator, higher the justified forward P. But dividend payout ratio is not, it is not directly related to your justified P ratio, right? It's not directly related. Now, why? In the previous class, guys, we had studied that retention ratio is equal to 1 minus dividend payout ratio. What was the retention ratio? Guys, can you tell me what was the retention ratio?
Which company does not pay it to the shareholders as
Yes.
dividend?
Basically, the percentage of profits retained by the company not distributed as dividends to shareholders. And what was my SGR? Sustainable growth rate, retention ratio into ROE,
ROE.
right? So, guys, higher the DPR, lower the retention ratio. If my DPR is high, then my retention ratio would be low, right? Can I say this, guys?
Yes.
If my DPR is high, my retention ratio is low. And if my retention ratio is low, then my sustainable growth rate would be low. Guys, can I say this, please? If my DPR is high, then retention ratio is low. And if retention ratio is low, then your sustainable growth rate is low. Guys, can we understand this?
Yes, sir.
So, guys, please understand this low retention ratio reduces the SGR. Why does it reduce the SGR? This is what we can see mathematically, but the actual explanation is that lower retention ratio basically means only a small portion of the company earnings are reinvested in future projects. So if only small portion is reinvested, then obviously company's growth is going to be low, right? Because only a small percentage of profits is being reinvested in future projects, right? So if my retention ratio is low, my growth rate is low. Okay. So guys, please note, high dividend or high dividend payout should increase stock price or increase justified P ratio. Should increase justified P ratio. Should increase justified P ratio. High dividend payout ratio should increase justified P ratio. But a high dividend payout ratio reduces your retention ratio, which reduces your growth rate. And low growth rate, low growth rate should increase justified or decrease justified P ratio. Low growth rate should increase or decrease justified P ratio. Please tell me. Guys, please tell me low growth should increase or decrease justified P ratio. Look at this formula.
Decrease.
Yes, if my G growth
Increase.
rate is low, then denominator would be high. If denominator is high, ratio, justified P ratio would be lower, right? So dividend payout, high dividends on one hand should increase the justified P, but high dividend payout ratio reduces the retention ratio. Lower retention ratio reduces sustainable growth rate, and lower growth rate means lower justified P ratio, right? Lower justified P ratio. Right. So that is why the effect of dividends on your justified P ratio is ambiguous. High dividend payout is in the numerator. Dividend payout is in your numerator. So since it's in the numerator, a high dividend payout should increase stock price. But a high dividend payout reduces retention ratio, which reduces growth rate, and a reduced growth rate should result in a lower justified P ratio. So the effect of dividends on justified P ratio is ambiguous. Guys, have we understood this point or not? Are there any doubts, please? Guys, have we any doubts? Anyone? Yes or no? All of you will say yes or no, please. Bolo.
Sir, please explain the high dividend wala part. High dividend payout ratio should increase stock price.
उमंग देख
थोड़ा सा repeat.
अगर ये डीपीआर तेरा न्यूमरेटर पे डिविडेंड पे आउट, तो जितना ज्यादा
Sir.
न्यूमरेटर हाई होगा उतना ज्यादा रेशियो हाई होगा, है ना? जितना ज्यादा डीपीआर हाई होगा उतना ज्यादा जस्टिफाइड फॉरवर्ड भी हाई होना चाहिए, बिकॉज डिविडेंड पे आउट इज इन द न्यूमरेटर, है ना?
Yes, sir. Direct relation. Yes.
हाँ, क्योंकि न्यूमरेटर है, हायर द न्यूमरेटर हायर द रेशियो, सो योर जस्टिफाइड फॉरवर्ड पी शुड बी हायर इफ डिविडेंड पे आउट इज हाई. लेकिन हाई डिविडेंड पे आउट, इफ डिविडेंड पे आउट इज हाई, देन रिटेंशन रेशियो इज लो, राइट उमंग?
Yes, sir. Then growth will be low.
And if growth is low, then denominator of this equation would be high. If denominator is high, justified P ratio would be low. ठीक है?
Yes, sir. Okay.
So there is
Yes.
an ambiguous effect of dividends on your justified P ratio is ambiguous. And guys, this effect of dividend on your justified P ratio is known as dividend displacement of earnings. Please write this down. This ambiguous effect of dividend on justified P ratio is known as dividend displacement of earnings. Again, I am repeating. This ambiguous effect of dividends on justified P ratio is known as dividend displacement of earnings. Very important. Right, guys, are we good? Koi doubt, please? Sankush, koi doubt? Ananya, any doubt?
Good, sir.
Supratik, Umang,
No.
Anmol,
Clear, sir.
Ayush, Sayed?
No doubt, sir.
Clear, sir.
Okay, so if it's clear, then solve these two questions. Stock A is in the FMCG industry. And the following are the fundamentals of stock A. Dividend payout ratio of stock A is 25% and industry is 16. Sales growth is 7.5 and industry sales growth is 3.9. And total debt to equity ratio of stock A is 1.13, industry is 0.68. Which factor suggest, the question is which factor out of these three factors suggest that stock A's justified P ratio should be low? Which of these, out of these three factors, which factor suggests that stock A's justified P ratio should be low?
GPR.
High DPR.
Guys, dividends impact on justified P ratio is ambiguous, right? Sales growth is high, so justified P ratio should be sales growth is higher than the industry growth, so
Hi.
justified P ratio should be high. Debt
High.
is high than industry. Stock A's debt is higher than industry. If debt is high, then required return
DPR.
should be, guys, required return by equity
Hi.
will high. If
High.
required
High.
return is high, then look at the
Low.
formula of justified P. Denominator would be high or denominator would be low?
Hi.
High.
High.
If denominator is high, then justified P ratio should be low or high,
Low.
right? So, guys, total debt to equity ratio suggests that stock is justified P should be low. Guys, are we good? Have you understood this, please?
Anusan, please.
Hmm?
Not
Sir,
to say so.
sir, one thing.
Hmm.
Like in the case of retention ratio, our retention ratio, organization is doing less, so means they are leveraging more debt to expansion, right?
No, it also basically, in our discussion, it basically means that it's not expanding, right? It's not expanding or it's not investing in future projects. That does not necessarily mean that if retention ratio is low, that does not mean that company is taking more debt. It does not mean that necessarily. ठीक है ना?
Okay. Okay.
Equity भी तो raise कर सकता
हाँ.
है ना? डेट की जगह इक्विटी भी तो रेस करके अपना फंडिंग कर सकता है ना, तो नॉट नेसेसरली मीन दैट कंपनी इज रेजिंग डेट. If its retention ratio is low, that does not necessarily mean कि वो it's financing its future projects by taking debt. It can raise equity as well, so it's not necessary. ठीक है ना?
Okay.
Supratik.
हाँ, sir.
Victor, what was your issue? Victor?
Okay, I got the logic now. The
If debt
the
is
cost of
high,
equity is
yes, if debt in the company's capital structure is high, then risk to
the cost of
equity
equity being
shareholders would
high.
be high. If risk to equity shareholders would be high, they would require a higher return to invest in the company's equity. So RE would be high. If RE is high, then the denominator of the justified P ratio would be high. If denominator is high, then justified P ratio would be low. So total debt to equity suggests that the company's P justified P should be low. Right, guys? Are we good? Any doubts in
No,
today's
sir.
class? So what we have learned today, which stocks we should invest in, which stock, guys? किसका स्टॉक खरीदना है?
Coal India.
Coal
Sir,
India.
value stocks.
Yes, it's a Coal India is a value stock. It's inexpensive given its fundamentals. ठीक है ना, तो ये कोल इंडिया अच्छा शेयर है, राइट? अदानी से दूर रहने का, राइट? एंड यू कैन सी व्हाट हैपेंस इफ देयर इज एन एडवर्स न्यूज इन अ हाई पी स्टॉक. Adani had a PE of 350, right? That is a humongous P, very, very high, right? It was a P that was hitting the rockets. It was like a rocketing P. So if there is a bad news in a high P stock, then there is a massive PE re-rating, right? P's fall very drastically if there is an adverse news in a very high P stock. So we should keep these things in mind, right? Although what we discussed today was only a drop in the ocean, right? These things are an ocean. We discussed